talking about the banking names, well, let's talk about IDFC FIRST Bank. Mr. Vaidyanathan, the managing director as well as the CEO of the bank, joins us on the show. Hi, Mr. Vaidyanathan. Good morning and thanks a lot for joining in. Well, the stock price reaction tells you that the street wasn't really impressed with the past quarter's numbers, or maybe they're a little bit skittish on the guidance that's given. So good to have you to clarify all of that. Now, you've guided for higher credit cost, at least in the first half of the fiscal. Why have you guided for higher credit costs in the near future? What kind of stress do you foresee? Please go ahead.
So before we come to your specific question, let me refer to your first point. You said markets didn't react well. See, the thing is that the newspaper reports came out that net profit for the quarter is down 10% over the last year. I just want to clarify that last year when we reported a profit of 801 crore, we clearly pointed out that we had a one-time treasury gain, by some off-market transactions, which gave us that kind of profit. The true profit was 700 crore. So against that, actually, PAT has gone up in a like-to-like basis. And a year-on-year basis, our PAT is up 24%. If you take out the treasury income, which we really don't in a bank upon, and nobody can ever bank upon, our PAT is up 28% over last year. So I think this one clarity I wanted to leave out to you. Now back to your second question on the
credit cost.
Question.
What is it? Credit cost, sir.
Yeah.
The credit cost is likely to remain elevated in the first half of the fiscal. Why? What kind of stress are you seeing? Please go ahead, sir.
Yes. First of all, we're seeing no stress. Let me put it plain and simple. Our gross NPA on the bank level running at 1.88, which is the lowest ever in the history. Our net NPA is some 0.6%, also quite lowest in the history. And our SMA, which is the pipeline leading to the NPA, SMA is the pre-NPA stage, the 0 to 90 DPD. That is also very low at some point. SMA 1 and 2 is just 0.85%. So let me just say there's no stress at all. Now, with regard to credit cost. Now, with credit cost, we are running a credit cost of less than 1% on a percentage of average assets. Less than 1%. It's already quite low. And for the next year also, we have guided for, but percentage of the loans outstanding was 1.32% this year. We're guiding for 1.6% next year because we're expecting normalization. Until last year, we were getting recoveries from COVID. We are now guiding for normalization, but even 1.6 is pretty good for the bank. It's come down from the past. So there's no stress. And let me just tell you, this is factored in the way we plan our model. And 1.6 is, you can check the industry, it's considered really quite good.
Okay.
Mr. Vaidyanathan, hi, morning. So is this sort of some calibration on growth that we should expect in FY25? Is that where this is coming from?
No, basically, see, how do you get loan growth? You get it from deposit growth. So from the deposit growth front, our bank grew deposit 40% last year, which I hope you'll agree is really something. On a large base that we already have. Next year, we are planning to grow deposit by 30%, which is needed for us because we need to grow our loan book and also need to repay some legacy liabilities. So we could plan to grow by 30%, and accordingly, we'll grow the loan book. So we always will want to grow our loan book lesser than a deposit growth because we want to improve our credit deposit ratio. And frankly, it's working well to plan.
Okay. So what is that number then? What do you expect it to grow by? I think FY24 advances growth was about 28%.
No, it is around, if you take assets, percentage of assets like 23%, and take a percent of loans is 25% currently in the year of 24. And this year, we expect to slow down a bit. Let me just say like maybe 22% or 23%. But we'll grow deposit by 30. And when we grow this by 22 and grow that by 30, our credit deposit ratio will come down. Our incremental CD ratio, we want to keep it at 80%, not more than that. And we want to do our credit deposit ratio, which was 140% 4 years ago. This year we brought it down to below 100, which we're very happy about. And by this year, we'll bring it down to 92%. So it's all looking good.
Okay. I wanted to understand a little bit about the cost to income ratio. With that declining, what is the medium-term target that you have for the cost to income ratio? It was elevated at more than 72% in Q4 of this year. So going ahead, what can we expect?
First of all, you should see it in context, because like we said in the last few years, we have set up, we grew branches from 200 to 900. ATMs grew from 150 to 1100. We launched so many businesses for doing rural banking because we were short on PSL sector. So we had a lot of investments to set the basic foundation right. The good news is that those will start paying back. One of the investments is credit card business. So good news that all start paying back. We feel that it has come down from 95 to 72. It's good progression. This year, our credit cost income ratio did not improve. I admit that it did not improve because interest rates went up and a few things happened. But next year, by Q4 FY25, we expect credit costs also to come down for the first time in our history to the 60s. So it will happen. As businesses scale up and start growing profit, the cost to cost income ratio will come down.
So which is the segment going forward which will sort of drive credit costs, which will also drive loan growth over the next, say, 1 to 2 years?
Credit costs, I told you, we are expecting a very good behavior of the bank. So really, there's no issue at all. This is our biggest badge of honor. For 14 years, our credit costs have never been troubled us. With regard to you said credit costs, you said one more question after that?
Loan growth. Which is the segment that will drive loan growth going forward?
Yes. So we want to, currently on the unsecured retail side, our loan book is about 15% and of the total book of the bank. And we want to grow the secured book more than that. And therefore, our areas of growth will be gold loans, going to be a big area. Right now, 1,000 crores. Planning end of this year, we're planning that book to be 3,000 crores. We want to grow the home loan book that we expect to grow well. We expect to grow loan against property. We want to launch tractor loans because we want to do the priority sector, agri-priority sector. So these are some focus areas for the bank.
All right, Mr. Vaidyanathan, two-part question then. The cost-to-income ratio, that's a little bit elevated, but you have mentioned in the past that you can see that, plateauing out in the times to come. I'm looking at your OPEX as a percentage of assets. I think that as well has moved up on a sequential basis. So give us a couple of numbers then. Cost-to-income ratio from around 72%, what does it come down to? Point number one. And the ROA in the past, you've told us as well, say by 2029, you see that number at around 1.9 to around 2%. If you could tell us in the near term.
Nigel, one question at a time, so it makes life easier. So
let's focus on the cost to income ratio first up.
Exactly. Yeah, it just makes I don't have to load any questions on my head.
Sure.
So the cost income ratio right now like 72%. End of this year, we can expect it to come to the 60s. Q1, Q2 will probably be in the same zone. Because there is some front loading of expenses happening because we're migrating from a FLDG structure from a non-FLDG structure and digital partners to FLDG structure. So without taking into technicalities, Q3, Q4, let me say is that we expect the cost income ratio to meaningfully come down, and we will celebrate when it comes to 60s because most people believe that our needle is stuck in the 70s. I'll show to all of you it will come to the 60s.
So by the end of this year, what does it come down to? By the quarter four, when we chat a year later, it'll come down to 60s, but you want to give us a number or a small range?
Yeah, I told you. Let me say the 60s, to get in the 60s barrier is a big moment, but it'll definitely happen because that's how the business is built actually. To give you one example, I'll give you an example. It'll drive home the point. Let's take credit cards. We launched credit cards 4 years ago. Last year, credit card cost income ratio was some 212%. Then last year it came down to 160%. This year it's still high. It is above something like 115, 116%, maybe 120%. Next year we expect it to come below 100% by end of this year. So every business, when you scale up, first you all run businesses. First you incur the cost. People come in, there's structure, there's technology costs, everything comes first. Then the business builds, cost come down.
Okay. By the way, Mr. Vaidyanathan, will there be a capital raise this year?
Yes, we are planning one capital raise this year. Yes. We think that
quantum,
we probably, let me just say that sometime during the course of the year. And it's also good because we're already running capital adequacy of 16%, as you know. We've just taken a 5,000 crore bond approval from the board just now. That will raise sometime in the course of the year. That also will, shore up capital. That's Tier 2 bonds. We'll also probably raise another round of capital this year. That will also strengthen the balance sheet. Unfortunately, since the price to book is still substantially above the book value, it will be adding value to shareholders because book value per share will go up if we raise capital at these prices.
Okay, Mr. Vaidyanathan, good chat as always. Thank you very much, and hope to speak with you mid-quarter to get a sense of how this one is going. Appreciate it, you joining us. Well.